Check out the iShares Value and Growth ETF. Growth more than doubling Value's performance so far this year. But our next guest says that has led to a wide price to earnings spread and a lot of cheap stocks. Joining us now is Bill Nygren, Oakmark Fund's partner and a U.S. CIO. Bill, it's great to have you back here on set. We have seen this incredible divergence between growth and value. And I do, just before we start getting to actual stock picks, want to get your thoughts on why that is and whether it's going to continue.
Well, at Oakmark, we've thought value's been really cheap for over the past decade as growth has outperformed. We thought last year, when value had a little bit of a tailwind, that maybe we were on the start of a multi-year path toward getting PE multiples closer together again. And we were quite surprised this year at how strong the growth tailwind has been. And the result of that for us has been we sold a lot of the growthier names that we bought last year, and we've used those proceeds to buy pretty traditional value stocks, single-digit PE companies.
So what are some examples of traditional value stocks right now?
Well, some of the ones that we added in the past quarter, Centene, the largest Medicaid insurance company, stock sells just under 10 times earnings. They're losing almost $1 a share in Medicare Advantage. They think they've got that problem solved. So if you assume that they will fix that next year, you're paying about 8 times, a little more than 8 times earnings for a double-digit grower. Company like Phillips Petroleum, they get categorized with all the other refiners, but Phillips 66 really has more than half of their value coming from non-refinery operations. So if we normalize refinery spreads, then the stock's still at about 10 times earnings, maybe a little bit less. And like a lot of the other oil companies, most of their excess cash flow is coming back to the shareholders.
It is interesting to hear you talk about Phillips, and I realize that you're very stock specific in terms of how you look through the market. But I mean, energy's had such a strong run the last couple of years. You
not the past week.
Well, that's just true. But I guess the point being the fact that you still see opportunities, value opportunities in energy.
Right. We would say that it's going to take a long time for the world to stop using fossil fuels, and the companies are priced like that's somewhere in the next 5 to 10 years. Most of these companies in this industry are single-digit PE ratios, and we think if the global economy is going to grow, we're going to consume more fossil fuels, and you need to have energy prices $70 or $80 a barrel for oil to encourage the existing companies to find more oil.
You mentioned Centene. You've also invested in CVS recently as well. I guess just looking at healthcare writ large, it has not had a good year so far, but we keep hearing about, and certainly having these conversations on this show, about the fact that healthcare, parts of healthcare, are on this secular growth trajectory.
Right, except for, as your last guest said, we're all going to start eating less, lose weight, and be much healthier. We tend to be skeptics when it comes to how rapid change like that can occur.
Okay.
And I think a company like CVS, which drugstores, pharmaceutical benefit management, also managed care operations, stock sells at 7 or 8 times earnings. They're deleveraging, they're buying back stock. We think that's really attractive.
I do want to ask you about some of the potential catalysts, or at least investor fears that are out there through the end of this year, one of them being government shutdown, because we're on pace for that, at least as it stands right now, to happen as soon as next week. How meaningful is that to the market here, given the fact that we've already seen so much uncertainty?
Yeah. Do you remember what the market did in December of 2018?
No.
That was the longest government shutdown.
Oh, yes, of course.
But the point is, it didn't do much to the market. By the time the government had reopened, the market was higher than it was before it had closed. It was 30% higher a year later. If you go back to the first time there was a government shutdown, 1981, the investor who put money into the S&P at that point in time has made 90 times their money, despite 21 government shutdowns since then. So the point to us is Investors get all worked up over this stuff. We get a government shutdown once every couple of years, and then a bunch of others that come right up to the line, and then they don't shut down. It just doesn't matter to the long-term investor who's really focused on trying to compound their wealth, grow their savings for retirement or college savings. And I think it's a big distraction for individual investors that they'd be better off ignoring.